Antony Abell. Antony, welcome to you. Were you surprised to see a slowdown in the monthly rate of decline?
No, it's largely expected at this stage. We're seeing a broad decrease in the value of property, commercial property, residential property over this year. We expect that to continue for a while yet. We have inflationary pressures obviously coming back up the other side. So largely speaking, the industry was expecting a decrease in the value of property.
We'll get on to commercial in a moment, but sticking with residential for a moment, it looks as though the rates of decline are now fastest in those areas where they rose most rapidly, for example, Scotland.
Indeed. In Scotland, the north, the rates are certainly in decline at this stage. It is interesting to note, though, we're still 4% over the previous 12 months on average across the UK. And indeed, if you look at the rate in June of last summer, it was 12% on the year. So, overall, the prices are still up, and people shouldn't forget that. But fundamentally, they are dropping. There is adjustment in the market taking place at the moment. But on the other side, we also have inflation coming up. So we have this aspect of nominal value versus real value.
Yes.
But in terms of the proportion of people's salary, if you look at earnings in that regard, we're still at 11 times earnings for a house in London. We're at 7 times across the country. In the north is doing a bit better, around 5 times earnings.
Yeah, these are very high figures historically, these multiples of earnings.
Well, indeed, but if you go back far enough in history, we're slightly on the macro side. If you go back far enough in history, you can look back to London being, at one stage, 12.4 times. And at the lowest, about 2.2 times in 1918. We're not sadly at that point.
Yeah.
But we do anticipate that as a proportion of people's salary, we'll see similar figures. So our fiat economy, our value of our money may be changing, the real value of it, its ability to purchase goods and services. But fundamentally, as a proportion of people's salary, we think the housing price is still relatively stable and will continue to be at that level after some adjustment.
There is a real big debate going on at this at the moment. I mean, it feels at the moment like we're in correction territory rather than crash territory. I mean, it feels like supply and demand are both tapering off at roughly the same sort of pace.
Yes, and indeed, if you look at the Zoopla figures, house buyers looking at new houses down 50%, and some of the government figures down 38%. So we do see less interest in buying houses. We do see affordability issues. Obviously, a tightening of money, increased interest rates. Interest rates are still, by Bank of England figures, up to 5.2 by the end of this year. So we still see those sort of figures coming through. Now, it's very interesting, the China news, where they're starting to give some relief to their industry. The industry has been caught up. Bill of materials are up, costs are up. It means the models that they have for their new builds are slightly out of whack to what they expected. They do need help. They do need support. They do need access to capital. And that capital is becoming more expensive. And that's also forcing the REIT market, for example, for people to do to call in some of their investments, and that's starting to bring that market down as well. So you have more supply coming into the marketplace, which is depressing some of the prices.
Absolutely. I mean, commercial property, obviously it's been through a pretty torrid time. A lot of office managers are grappling with hybrid working and the return to the office and so forth. How much bad news is in the share price for a lot of these listed REITs?
It's hard to read at this stage. Our pandemic has obviously changed our working habits. To what degree is still uncertain. As a society, we're still working that out. It is changing. We find conversion of some of these properties going to new use cases. So some of the retail is going back to residential, for example, in some quarters. So that's still to find its bottom as such, still to find its feet. But there is still value there. And indeed, for most of us working in London, we get a lot of our bosses saying, you have to come into work now. So we think that there's still an upward trend in that marketplace in due course once the market settles.
Yeah, now you mentioned the China thing. I find this absolutely extraordinary. I mean, the Chinese property market obviously has been weaker, but surely you just let market forces, take their turn.
Well, as always, there's the aspect of what the government wants versus what the market wants. And markets don't like politics. They don't like to get involved in that. But this aspect of making sure that you have the movement of capital inside of our economies, drives tax receipts, drives some of the social programs that our government has. It's absolutely essential for governments to make sure that we keep the movement velocity of money in the economy. So yes, they're throwing some help to the property industry because they realize if they don't, there could be further problems stored up there in the future. So it's a tough balancing act. I wouldn't want to be in the Bank of England right now in terms of, and the Treasury to balance that right now.
No, but in China in particular, I mean, there are already massive concerns about the levels of indebtedness in the commercial property sector in particular. Why on earth are they potentially going to make it easier for these companies to borrow more?
It's always the case. More money chasing fewer goods, services, leads to inflation. Most of our inflation as a opinion is not necessarily based on our supply chains, not necessarily based on Ukraine or wars. It's based upon the monetary inflation, the increase of the money supply ostensibly over the last 50 years. We actually predicted back in 16 and 17 that we'd see double-digit inflation around now. One of the few. We're macro guys. It makes us a little boring at times, I'm afraid. But what it does mean is that those issues are systemic and endemic to all of our economies. And so we're seeing adjustment not just in terms of the housing market where it fits in, but the value of our money in those markets as well, and how our economy works with inflation, how the future holds. Now, there's a lot of things happening in the marketplace right now. There's a lot of change stored up in the marketplace. A lot of that still to be seen in terms of its outcome. Governments are trying to manage the process to protect their societies, protect their economies. But fundamentally in all of this, and this is something I think all governments are working toward, is this very much this aspect of creating stable currencies. Because if they can create a stable currency, they can create a stable infrastructure, a stable economy, and then ultimately they're able to create a stable society. So a lot of these things are going on in all the minds of all of our politicians.
All right, Antony, we have to leave it there, I'm afraid. Good to talk to you this morning. Thank you.
Thank you very much.
Well, as promised, we're going back now to the Consumer Electronics Show.